Today's topic, your biggest investing questions for the second half of 2025. A topic that is requested often, but a topic I usually don't dig into too much because it is very hard to give investment ideas, topics in a one to many format because your goals are completely different from someone else's goals. And while I may say this about diversification and why this may look good, it may not fit your goals, your allocation, your risk tolerance. So it's a tough topic, but we have been pounded on this topic. So between questions from YouTube, but also we're also in review meeting season right now for our clients, we have client questions. So I figured, you know what? We're going to use a unique format where we're going to put out some of the more broad-based topics, give you some high-level overview of it, and then you do what you want with it, right? You take it as you need to. So it's not investment advice. We're just talking about investment topics. And we got five good ones today. Very big topics, topics that you're likely already talking about or you're seeing pop up, Wall Street Journal, Yahoo Finance, whatever you get your financial news from. That's what we're going to cover. So stay tuned. 5 of those questions coming up next. All right, before we get into it, as always, quick favor to ask. If you have not subscribed to the channel, now's a great time to do so. Click on the bell icon, get a notification every time we release a new video like this one, like we do weekly. Give us a thumbs up, share the message. Also, if you think, you know what, this guy seems pretty smart, he seems like a good guy, thinking about firing your current financial advisor to look for a new one, you can always schedule an icebreaker call on our website, wealthkeel.com, right in the top corner. That's it. Those are the 2 pitches into the content. So where do we stand today? That's question 1. Where are we? First half of 2015. 2025, holy smokes, I'm all over the place today. So 2025, 2015, who knows what was happening then? 2025. Well, do you remember back in April when the S&P was down 15% and everyone thought, oh my gosh, the world is ending. Here it comes. We knew it. And then quickly after that, we had one of the most rapid responses in the stock market, which has seemed to it's been a kind of a trend. I'm sure there's good data on this, but it feels like every large pullback we've had over the past few years, the rebound was very quick. But if you go back to April, the S&P was down about 15%. So what's happening right now? What's happening? Well, a few things. We have steady growth, not sexy growth, but steady growth. That has been a big factor in here. What are the headwinds per se? What are the main concerns? Well, tariffs, right? Tariffs was the initial, that big decline back in April. That was the culprit, right? It was really that tariff conversation that scared the bejesus out of everybody. That also has an effect on trade policies. Two big stock allocations, right? We got U.S. and international, at least in terms of equity. U.S., pretty good year so far. I'm not going to give you numbers because by the time this video goes live, things can change, but pretty solid mid-year number for 2025 for U.S. The leader in the clubhouse, though, has definitely been international. International has outperformed by a large amount, which is why I will tell you question number 4. Stay tuned for that one. So that's where we really are today. Steady growth, not sexy growth. Still have some headwinds coming out. We just finished up, but by the time this goes live, from a recording perspective, the One Big Beautiful Bill has passed. That also added a little bit of clarity on the tax situation. There's a lot of big tax updates in there. So good at the mid-year. U.S. markets, decent performance. International markets, much more solid performance there in terms of equity markets. Second question, the next big conversation we get, one based on recent comments, questions sent to us for the YouTube channel, but also, again, in our client communication, tariffs, right? Are we going to end up in a recession from tariffs? If you asked us that in April, probably a little bit of a different response, that we were a lot more concerned. Here's where we stand now, right? Stable employment, moderate inflation, trade-driven GDP is pretty strong. So check the boxes, right? That's likely not a crisis. Slower growth for sure. Like we said, steady GDP, but not sexy growth. With the tariffs and the trade policy, the main concerns would be, is it going to drive cost up? Is it going to slow down growth? Consumer prices, right? That's a big one in there. And inflation in the Fed is a whole other conversation, which we'll actually walk into next year. So as we sit here today, and this could all change in a minute, it doesn't feel like tariffs are going to lead us into a recession. Is it creating some headwinds? And you can even say, when some of these headlines go out, markets do take a little bit of time to digest that. If we can go back to our April story, big pullback, really big pullback, and then really big rebound there. So a lot of headline news. As I always say in investing conversations, is you got to be able to control your emotions. In today's world, you are getting hit with news headlines, whether they're right or wrong, right? Hashtag fake news. You need to control your emotions. One of my best investment strategies is always control your emotions, keep investing no matter what, keep your internal costs low. If you can do those three, probably got a pretty solid platform going. All right, number 3, interest rates and bonds. Another very common question that we get. Inverse relationship between interest rates and bonds. We'll keep this section a little bit shorter. Who knows? It seems like the Fed and the Trump administration's kind of like the headbutt every now and then. As we sit here right now, the prediction, the odds are still 2 rate cuts in 2025. Some would have said by right now that they thought maybe we would have had one by now. We haven't. That will be important. That really plays into the inflation conversation, but it also has a much broader effect on a lot of things as those rates move. And when rates are moving, it also has an effect on the bond market. Remember, inverse relationship there. It's been nice having a little bit higher rate for all of our older clients where bonds are a bigger portion of their portfolio. It's nice to have a little bit of yield again from bonds. So we'd love to see that continue, but we'll kind of see how that all plays out. But interest rates and bonds have been really, I'd probably say, the second most popular topic, only because that first one we listed was more or less a look back on the first half of 2025. We had a big question on this to actually put a note in there for the white coat investor on this same topic here. Global versus U.S. This one has really come up for almost the past decade. The U.S. has been the leader in the clubhouse for a decade. I forget the exact number. We had this in a different post, but if you look back on the chart that shows you every single asset class and how they performed over that year, there was a period of time, I believe it was a 10-year window, where not just like U.S. markets, like maybe mid caps or small caps, U.S. large cap was the winner, or in the top 2, I think 6 or 7 of those 10 years, like just straight domination by the U.S. markets. But as we sit here right now in 2025, I believe it's almost, if not double, almost triple. I think the international markets are up almost triple, at a minimum double what the U.S. markets are in terms of like either developed international or U.S. large caps. So global international has had a very strong start to 2025. Will that continue? Who knows? Even at the end of last year, when Vanguard released their outlook, they also put a note on this, that they also see international being a positive bright spot in a diversified portfolio going forward. And so far, midway through 2025, solid win. Why is global standing out right now? The main notes that I wrote down here are we have better valuations, better economic conditions in key areas, and the one that's always important here is a weaker dollar. So whether you're talking about developed international or even emerging markets, you should not give up on a diversified portfolio. I know over the past 10 years, U.S. has been the outperformer, and when you look through your portfolio, you're like, oh my gosh, why didn't I put everything in the S&P 500? It's not that simple, right? And there will be moments when international shines. Don't think of international as how'd you do this day, this month, this year. Think about it as long-term. You should still be a fan of a diversified portfolio. International should be a part of that. And when we say international, we do believe that, large cap international, but we also believe in the international or the emerging markets as well. Clearly, this has to match up to your risk tolerance, right? The younger you are, the more comfortable you are with risk. These fit very well into a lot of those portfolios. If you're on the tail end, you're in decumulation phase, you might not have to reach for this type of risk. Or if you do, it can be a smaller portion, which is why these videos are very difficult to say like, hey, international is great. Great, like it could be, but it doesn't mean it's a perfect fit for your portfolio. So make sure you're doing your own research, you're having conversations with your financial advisor as well. But again, we are fans of international, and we do believe that they still belong in your portfolio, not only today, but as you go forward. So long term, what are we keeping an eye on? Some of this has, I mean, healthcare has been on our short list for a while. So we do believe that healthcare is in a really good spot, whether we get into biotech or we just get into a very aging population. That's not just a US thing, that's an international thing, right? So that is a sector that is still interesting. And then how can you not be thinking about tech, right? So we can get into AI, we get into cloud, cybersecurity, just at least in terms of my day to day, right? AI, cloud, cybersecurity are just part of everything, right? It's literally ingrained in everything these days. So we think that those are two really good areas to keep an eye on. Sustainability is another big one. AI, I noted in there, aging population, those will drive the long term growth. So that's where our view as we sit here today. Also, clearly, WealthKeel is using a lot of outside research, whether that's from the investment partners we work with, like Vicus Capital, or even the research we see from kitchens.com. That's what we're gathering. We're lifetime students, right? We're always learning. We're always getting more information in here. So we have lots of good resources on where we're getting this information from. So that's our view on where the long term looks brightest. As I noted in the middle of that, when you take all this back, what's the main thing? Control your emotion. Control your emotions, and you should be in a very good spot long term. In today's world, with social media, news is around you all the time, whether that's correct news or wrong news, it can have an effect. So you got to be aware of that. Control your emotions. Continue to invest. I can tell you now, back in April, when clients were getting scared, if we were saying, hey, if you're a long-term investor, if you have cash on the sidelines, you have some dry powder to put into play, it's a good time. Now, hindsight, sure, that was a quick rebound. That was a huge win. It doesn't always play out that way, right? We can also say that in April and the market keeps going down. We could be in a much longer bear market. We could be in a recession, right? There's a lot that can go wrong there. But if you think of things, I would say the market should always be a 10-year investment. Anytime you put a new dollar in the market, your goal should be, I'm not touching this at least for 10 years. Let a full market cycle play out. That's where we have very high probability that your dollar should be worth more, 10 years from now. And again, it depends on where you pick it up in the cycle. Crazy things can happen. But investing is a long-term play, not a short-term play. So there you have it. Honestly, I can't remember the last time we did an investing type topic like this. If you like this, give us a thumbs up. If you have questions or you'd like to see more of this or you want us to get more detailed on certain things, drop those below. Like I said, it's a topic that I like to kind of tread lightly on because it's a tough one to give that one to many, but I feel like this format actually plays really well. So if you like this, you have questions, drop a comment below. You can also, in our show notes, we have the Google form where you can send us a more private note. But regardless, thank you for hanging out with me. Let me edit this, call it about 12 minutes or so. So a little bit shorter than the old 15-minute, but we feel like it's a good duration there. As always, thanks for hanging out with me, and I will catch you on the next video.